Now speaking, Jeff Seaman, Vice President, Investor Relations. Good morning everyone, thank you for joining us today for our Q&A session on our fourth quarter and full year fiscal 23 results. Management provided an overview of the company's financial performance in their prepared remarks and accompanying press release. Key highlights include a 4% increase in sales to $35.4 billion, a 3.9% comparable sales growth in the retail segment, a 6.1% increase in operating income to $3.6 billion, and a 6.8% increase in adjusted earnings per share to $3.45. Management also announced a 5% increase in dividend payments this year. With these strong results, management is optimistic about the future prospects of the company and confident in their ability to continue driving value for shareholders. Mizuho Securities analyst John Baumgartner inquired, Jeff, with the investments made last year and conditions getting back to normal, what offensive strategy are you pursuing for growth at Mills going forward? Jeff Harmening replied, thanks for the question, John. This past year we saw impressive growth in sales, 10%, operating profit, 8%, and earnings per share, 10%. We invested heavily in marketing and capabilities to support future growth. We are confident that our metrics will remain on track and ahead of our long-term dividend growth targets. We have been investing for growth while simultaneously driving higher levels of productivity. Our Nielsen data from last week reflects this. We believe that continued supply chain normalization and agility will enable us to drive gross margin and create a positive feedback loop for growth. We remain excited about our new product innovation and marketing ideas for the year ahead. J.P. Morgan Chase & Company analyst Ken Goldman inquired, can you provide some insight into the decline in retail inventory this quarter? What drove the decrease and what gives you confidence that it's not a General Mills-specific dynamic? Jeff Harmening replied, Ken, I understand the surprise with the factory inventory decline in this quarter. We had a 5-point headwind that we didn't see coming when the quarter began. Despite that, we hit our guidance on profitability and exceeded margins and EPS. The decrease was due to a couple of big customers trying to get their inventories back to a good place. Carrying costs of inventory and interest rates were factors in their decision. It's not a red flag for us or the industry, and we don't anticipate it happening again. John Nudi replied, yes, absolutely Ken. We saw a 5-point gap between the Nielsen movement in Q4 and the prior quarter. This is a trend we have seen for 6 of the last 8 quarters. Retailers are focused on inventory given recent supply disruptions and high costs of inventory. We have seen some of the lowest levels of inventory on record and don't believe they can go much lower. However, we can control our marketing, driver baselines and merchandising to ensure good movement in Q4 and don't expect to see another leg down in fiscal 24. J.P. Morgan Chase & Company analyst Ken Goldman inquired, can we expect organic growth to accelerate this year despite the supply issues? Jeff Harmening replied, we had a difficult first half of the year due to capacity constraints. We've since rebuilt our capacity and achieved service levels in the 90s. We met our goal of double-digit growth in the second half of the year and saw positive results from our dry pet food, treats and life protection formula advertising. Wet pet food lagged, however, we expect supply not to be an issue this coming year. Although profitability won't improve until we internalize all our capacity in fiscal 25. Barclays analyst Andrew Lazar inquired, will volume in fiscal 24 improve over the -4% decline seen in 23? Is there a possibility of organic sales being negative until volume catches up later in the year? Jeff Harmening replied, we expect our top line to grow 3 to 4% and to see mid-single-digit inflation of around 5%. We anticipate that our pounds will be better in fiscal 24 than they were in fiscal 23, though it is difficult to predict if they will reach positive territory due to the mix factor. For example, in China last quarter, sales grew nicely but pounds were down due to the sale of more expensive Haagen-Dazs ice cream and less Wankai Ferry dumplings. We also saw this in our food service business, with less flour being sold and more of other items. Pricing should help offset this, as we still see inflation in the marketplace. Kofi Bruce replied, Andrew, this is Kofi. We anticipate stronger growth in the first half of the year compared to the second half based on current comparisons. Barclays analyst Andrew Lazar inquired, what is driving retailers' inventory reductions despite increased merchandising activity? John Nudi replied, Andrew, I've spoken with a few of our key retailers and it appears they are focused on getting inventory levels back in check. We have gone through some supply disruptions in the past 6 months, so with the supply improving, they feel comfortable holding less stock. As we look to the future, they don't plan to decrease inventories further, and if we can increase sales, they will continue to invest in inventory. UBS analyst Brandon Cohen inquired, what categories and characteristics are you targeting for M&A activity with your current debt levels? Jeff Harmening replied, our balance sheet is in excellent condition. We've achieved profitability over the past few years and have worked diligently to improve our payables and receivables. We are disciplined in our approach to mergers and acquisitions, aiming for a 50 basis point growth over the coming years. We'll be looking for opportunities that are accretive to our growth in categories where we have an advantage, and where possible, synergies that will create value for shareholders. Morgan Stanley analyst Pamela Kaufman inquired, what are your thoughts on gross margin in fiscal 24 and how does the anticipated 5% input cost inflation affect it? Jeff Harmoning replied, thank you, Pamela. Our gross margin was a highlight for the quarter and has been for the past year. We are very proud of our accomplishments in this area. I'll have Kofi provide more detailed information. Kofi Bruce replied, we've made considerable progress in returning to pre-pandemic gross margin levels. And with inflation moderating, we anticipate further progress as the year progresses. Our home levels should see a 1-point increase from the past couple of years, and our cost-cutting initiative should help drive us back to pre-pandemic gross margin. Morgan Stanley analyst Pamela Kaufman inquired, what is your outlook for promotions and brand building in fiscal 24? What is the mix between price promotions and marketing and advertising? Jeff Harmoning replied, the inflation environment is essential to consider when looking ahead to our marketing and promotional efforts. We anticipate that promotional frequency will increase slightly, as retailers have more confidence in our supply chain now that service levels are back up to the 90s. This will lead to improved display merchandising, which has high returns for both us and retailers. As far as marketing, we have been investing heavily in this area and in line with our sales growth, our marketing spend is already 35% higher than pre-pandemic levels and we plan to continue investing in order to provide customers with new ideas and ways to grow. Evercore IC analyst David Palmer inquired, what challenges is the company facing in setting fiscal 2024 guidance, and what variables are being considered beyond North American retail consumer demand? Kofi Bruce replied, yeah, consumer behavior is definitely impacted by interest rates and the potential for economic slowdowns. Inflation is currently higher than expected, making it difficult to set expectations for the year. We are confident that whatever environment arises, we will be able to adapt and respond accordingly. Evercore IC analyst David Palmer inquired, how have recent industry trends influenced North American consumer demand in the upcoming year? Jeff Harmoning replied, David, I understand your concerns. We previously discussed 3-week data in December due to worries around holiday sales and it turned out to be better than feared. While the last 2 years haven't seen much change, our volume elasticities have been increasing over the past 12 weeks as anticipated. This is included in our guidance for the year. We do expect elasticities to go up, but that's already accounted for in our guidance. So, while 3-week trends should not be followed too closely, we're not surprised by the current trend. Exane BNP Paribas analyst Max Gumport inquired, could you elaborate on the trends in wet pet food and the potential for recovery moving forward? Jeff Harmoning replied, Max, the pet category is a $50 billion industry and there are several trends at play. Humanization is still occurring and this is why dry pet food sales are recovering. Though, mobility has led to decreased home time for consumers and this has had a downward pressure on treat and wet pet food sales. Additionally, inflation is leading to further declines in certain areas of the segment. Overall, wet pet food has not seen the same level of recovery as expected due to these factors. Exane BNP Paribas analyst Max Gumport inquired, what capacity increase in counts can we expect for pet hot snacks and fruit snacks in fiscal 24? Kofi Bruce replied, yes, Max, our capital investment plans are on track. We will see the capacity from the first 3 platforms come online this fiscal year, with the pet platform coming late in the year. This will give us the ability to supply some of the dry dog food needs internally. Jeff Harmoning replied, Max, supply disruptions have been a major boon for us. Last year, our yogurt and bars had some serious issues. This time around, we're in much better shape. In North America retail, we're confident that we can meet all of our requirements and support our merchandise. It's something we feel very proud of. Jeff Seaman replied, Max, this is Jeff Seaman. Our internal capacity comes online in about a year, but we have had external capacity available in the last couple of quarters. This has allowed us to improve our service for both treats and dry goods. Stifel Financial Corporation analyst Matthew Smith inquired, can you provide some insight on the margin recovery in fiscal 24? What elements are driving it and what are potential limits? Jeff Harmoning replied, in terms of margin expansion, we have taken pricing steps which are reflected in our current results, including Q4. Additionally, productivity levels and a stable supply chain have helped reduce costs. We also have external manufacturing, which limits the benefit of cost savings. To balance this, we are investing in marketing and capabilities to drive top-line growth. This may lead to more gross margin expansion than operating margin expansion, as we reinvest savings into top-line growth. Kofi Bruce replied, I want to emphasize that there could be a slight headwind from our production mix due to the macro trends Jeff mentioned. This should be taken into consideration when estimating our profitability. Bank of America Merrill Lynch analyst Brian Spillane inquired, Kofi, what's driving the improvement in free cash conversion from 80% to 95% next year? Kofi Bruce replied, yes, the primary driver of the miss this year was unexpected inventory build in the retail trade. We are making progress on our pet business and overall core working capital, which will give us more visibility and help us manage our inventory levels. This should provide a significant cash flow from working capital next year. Bank of America Merrill Lynch analyst Brian Spillane inquired, can you provide more detail on the inventory improvements and how they impacted the quarterly earnings? Kofi Bruce replied, year over year, our cash flow has seen an increase. This is a good indicator. Bank of America Merrill Lynch analyst Brian Spillane inquired, Kofi, could we reduce interest expense by using free cash flow to pay off some of our shorter-term debt? Kofi Bruce replied, we expect to be able to reduce our commercial paper balances and run with that lower balance due to our ability to issue term debt at more attractive rates than what we could get in the commercial paper market. Bank of America Merrill Lynch analyst Brian Spillane inquired, what are the steps being taken to reduce the guidance? Kofi Bruce replied, I expect this to be a modest headwind as our term debt rolls off and we remain in this higher interest rate environment. The impact is manageable, as the majority of the debt matures within 2 to 3 quarters. Wells Fargo Securities analyst Chris Carey inquired, do inventory cuts affect consumption, and is there potential to take additional pricing in fiscal 2024 beyond what's already in the market? John Nudi replied, yes, our on-shelf availability is significantly higher than a year ago. We've invested in digital capabilities to ensure retailers can manage their inventory efficiently and keep shelves fully stocked. As a result, they don't need to hold as much inventory, and this doesn't hinder us from getting the displays we seek. Jeff Harmoning replied, in terms of pricing, we have already implemented most of what is necessary in the marketplace. We are conscious of inflationary pressure which can differ in different geographical markets and may require additional adjustments in certain categories. However, we feel good about what we currently have in place. Wells Fargo Securities analyst Chris Carey inquired, Jeff, what tools do you have to reignite volume growth if consumer demand shifts? Are more promotions, advertising and merchandising part of your strategy? Jeff Harmoning replied, the promotional environment in our industry has been quite rational, and I anticipate that will continue. To drive growth in the year ahead, I'm confident we'll see an increase in new product innovation, better distribution of existing products and higher quality merchandising. We're investing in our brands with improved marketing, which should result in increased consumption and be a source of growth for us. Jeff Harmoning replied, we are proud of the results that we have achieved this past year with 10% sales growth, 8% operating profit growth and double-digit earnings per share growth. This was despite a 3% headwind from divestitures. Moving forward, we remain confident in our ability to meet or exceed our long-term growth algorithm for sales, operating profit, EPS and dividend increases. We have proven our ability to succeed in varying market conditions, and are optimistic that we will continue to do so in the upcoming year. Jeff Seaman replied, all right, that's a wrap. Thank you for your questions and your time. If you have any follow-up questions, we are available throughout the day to answer them. We look forward to continuing this discussion later in